Why everyone is looking for the liquidity in the markets? Because if you learn the art of finding the liquidity in the markets, your life is never going to be the same again. There are the exact levels where millions of buy and sell orders are resting within them. So when the price approaches to these levels, those liquidity pools might completely reverse the price to another direction. So in this video, I will teach you how to find 3 best liquidity points from the weakest to the strongest one. Hello folks, welcome back to OP Investing. My name is Islam and here I teach anyone who have an extra 15 minutes a day to scale their trading to 6 or even 7 figures profits with a pure mechanical edge over the markets without complex analysis or being glued to the charts. So make sure to subscribe not to lose this channel. If you know, the markets move based on the supply and demand. There are always people who are looking to buy and those who are looking to sell. If there are more buyers in the market, the price is gonna go up because the demand exceeds the supply. And the vice versa is true if there are more sellers in the market. The price is going to go down respectively. If you look at the charts, the price patterns leave us a clue of potential points where people actually have their pending buy or sell orders. So if the price approaches to these levels, these orders will be triggered and affect the price. This is a reason why so much people are obsessed with the liquidity levels, because they are literally the fuel that moves the market. Basically, there are 3 liquidity zones and each of them comes one after another. But again, using them alone might be a mistake. Make sure to watch this video till the end and I will tell you where you can learn how to integrate all of these liquidity pools into a working strategy. Just keep watching. The first on our list is imbalance. Let's first cover what is imbalance, why it is important, and later we will cover a couple of examples of how imbalance is traded. First of all, what is imbalance? Imbalance is a sort of hollow gap between candles that are created after impulsive movements. As you can see over here, we've got the huge impulsive movements to the downside. This is a first candle, this is a big second candle, and this is a third candle. And between them, we have this hollowness. The wick of the first and the third candle are not intersecting, which means that we do have the imbalance right over here. These hollow gaps are created because of the excessive amount of buy or sell orders that quickly moves the price. These hollow gaps keeps in them unfilled orders left unmitigated because of the shortage of the opposite side of the deal. As you can see, the imbalance might be big, like you see over here, or it might be small like you see over here, but we are interested in the big impulsive movements, big impulsive imbalances, because it is so important, because it indicates a strength in the market. Imbalances are literally the first point of interest that comes in our way when we want to enter the trade. We should not trade any entry patterns alone. They are not going to make any sense on their own. Instead, we have to focus on the context of the market, aka defining the trend. The best way to do that is by reading the market structure. So imagine you have opened your charts and identified where the price is going. Then we have to wait for the pullback against the direction of the trend. Imbalance is something that will confirm the strengths of the trend and we can use it as an actual point of interest to place our trades. Let's cover this example, guys. As you can see, the market structure is bearish. The price made the strong pull to the downside, retraced to the upside, and then made another strong impulse. Like over here, you can see we do have the strong impulse to the downside, making the new lower low over here. And after that, what is happening? The price is retracing into this imbalance over here. You can see it's retracing into the imbalance and then going to the downside, continuing its impulse to the downside, as you can see over here. So basically, we do have the market structure, the price makes the higher high, and somewhere over here, we are going to have our imbalance. So imbalance is literally the first place where we are looking for our entry. But there is the point of interest that comes after the imbalance. and that is called the point of origin. This is the exact place where the price originated its impulsive moves in the direction of the trend. Not always we might have the imbalance inside of the impulse. Most of the times the movements in the market are just moderate without the strong movements. In that case, for our point of interest to enter our trades, we can use the last opposite move before we had the impulse. So basically, guys, when the price is making this impulsive move to the upside, we're not gonna have imbalance all the time. There might be some moderate moves to the upside, so there is no there is no imbalance on the way. This is where we'll look for the origin point. It's just a place it's just a last opposite move before the impulsive movements occurred. This is where we do have a lot of orders and we can place our trade over here. And basically, like we can look at this example over here. You can see we did have these strong movements, imbalance. The price retraced from the imbalance, reversed from the imbalance, and made another impulsive movement to the downside. But over here, we don't have a lot of imbalances. As you can see over here, all the imbalances are filled. And this is where we do have the origin point. Exactly this trade, the OP investing method number 2 trade was taken from here. This is a last opposing move to the upside before the price made the strong movement to the downside over here, as you can see over here. So basically, this is maybe some of you know this place as an order block, but this is an origin point. I call it origin point. And I do have one hint, just advice for you. For example, we do have some internal structure over here. By the way, you can see the price made the lower low here, over here, and it's literally tapped into this imbalance over here. As you can see, it's tapped into the imbalance and moved to the downside. Personally, I do low to draw the fib levels. As you can see over here, we drove the fib levels from this high to this low over here, and we place our trades around the golden zone, which is from 80 to 60% retracement level. So you can place your trade at the 60, place your stop loss above the 80%, or you can place your trades at the 60, 70, or even 80%, and then place your stop loss above this high, above the swing high. And as you can see over here, you can see this is exactly what happens. Over here we do have the impulsive movement, and then the price is reversed exactly from the 80% retracement level. But I have refined it that I didn't use like the order block exactly. I didn't use the fib levels exactly on this case. Instead, I focused on this origin point over here. You can see where the price has reversed to the downside. So basically, guys, as you understood that we do have some imbalances on our way, we do have our origin point where we can trade the retracement. So this is the least strong one. This is the weakest one, and after that the order block is a stronger one. It is much stronger than this one, but there's the last liquidity pool that we have to pay attention. It's a swing highs and lows, but in this case we trade swing highs and lows a little different than the previous 2 levels that we have talked about. These bad boys keeps the ton of pending and stop orders behind them. So here we will be trading the sweep of these key highs and key lows, as you can see over here. For example, just imagine the price went down, the imbalance failed, the order block failed, and after that the price is sweeping this key swing low over here. It is sweeping it and then reversing. We do have a lot of liquidity below these lows. Trading the sweep of the key swing levels is so overcomplicated in the trading community, and I want to break it down to you, all of the false info once and forever. I want this information to be a new general rule of thumb when it comes to trading the liquidity grabs beyond the key levels. First of all, let me tell you, for you to be profitable with something, you need to focus on trading the mechanical strategy. So picking up the levels should be as mechanical as possible. So if you have marked up the random level and won a couple of trades, that might be just a luck. For a level to be mechanical, me, you, and anyone else who looks at the market and follow the rules should be able to see the same thing easily with the straightforward rules. After many years of trading, I found out that these levels are highs of the day, week, and months. These levels are 100% objective because they are the same for everyone. Personally, I love trading the sweep of the previous day high and low because I'm focused on trading intraday levels. So let's cover up a couple of examples. So basically, guys, when you look at the charts, we do have like millions highs, million lows, like that are not 100% subjective. Like which one of them are gonna have the most liquidity? We don't know. That is why I recommend for you to stick to daily highs and lows, weekly highs and lows, and monthly highs and lows. These levels are objective. Like the high of the day and the low, the high of the week and the months high and low are going to be the same for you, for me, for anyone else. You don't need any experience. You don't need anything like any ability to read the market structure to identify them. They are unique. They are the same for you, for me, and for anyone else. For example, like we do have sometimes the sweeps. As you can see over here, we did have a little just by a tick over here. You can see. We did have the sweep of the previous day low. This is one, like these cyclical lines identify like each day. So this was the low of the previous day candle. We did have the sweep, and then we did have the OP investing method number 4 trade during the key New York session, as you can see over here. So basically, if you want to day trade, I would suggest you to pay attention for the daily high and low. If you want to swing trade, I would suggest you to pay attention to the weekly high and low. If you want to hold your trades during the months, it's a short-term investing probably. I would suggest you to pay attention to the previous months and previous months highs and previous months lows. These places are just packed with a lot of liquidity, and these places might just make the price reverse. So basically, folks, we have covered 3 key liquidity pools for trading that you will ever just need. Like you don't need more than this, guys. Just focus on these 3 key liquidity orders. But guys, on their own, these are just the tools that are useless. So I have prepared 1 hour long free training where you will learn my complete strategy that will help you scale your trading to 6 or even 7 figures in just 30 days. Just click here to watch it.